Hi, good morning, and welcome to the latest Bridging and Commercial virtual roundtable. Since February, we've been running these on a weekly basis with the purpose of exploring subjects that matter to the lending and broking communities and which impact all stakeholders. My name is Caron Schreuder. I'm the Managing Director of Medianett, publisher of Bridging and Commercial and Development Finance today. For this morning's live session, we are sponsored by Allica Bank as we dive into the world of owner-occupied business lending. Charissa and Nick from Allica are with us, as well as an expert panel of brokers who will shortly be introducing themselves. Thank you to our panel for spending this hour with us and for sharing your knowledge in this part of the market. And thank you to our viewers for tuning in. Please be reminded that you can ask the panel questions throughout the session by using the option for this on your audience dashboard. We'll try to get to as many of these as possible. As mentioned, our topic for today is owner-occupied trading businesses and why this mortgage market is so underserved at present. Now, there are some pretty obvious reasons that spring to mind in the form of COVID and the immense disruption that this has caused retailers and service providers for over a year. However, with the world slowly reopening, it is vital that there is support for these businesses now more than ever. It could be your local coffee shop, pet store or hair salon, if I had to list three of my essentials. And after the period that they've had, getting a commercial mortgage may form part of their plan for survival, growth or diversification. Essentially a strategy that will go a long way to securing their future in our towns and cities. Throughout the various lockdowns, Allica Bank has really come out to bat for businesses. So it made perfect sense for us to partner with them for today's roundtable. Research conducted by Allica in September last year indicated that a whopping 97% of brokers felt that commercial mortgages would be underserved in the following 2 years. Its Q1 2021 broker survey confirmed that 82% of brokers polled had witnessed a reduction in available products from business lenders, and over half of these brokers said that that reduction was significant. In Nick's own words, government schemes, although a lifesaver, have tied up lender capacity, leaving small businesses that are looking for funding hamstrung. It appears that those providers that have re-entered the market are more focused on commercial investment products than operator-led ones, making these SMEs' ability to recover and thrive post-pandemic doubly difficult. This is just a small bit of background about the issue. I'm going to leave the panel to dive deeper into the nuances of owner-occupied business lending, and most importantly, how brokers can get the support for their clients that fall into this category. I'd now like to ask the panel to introduce themselves, please, starting with Charissa.
Morning, everybody. I'm Charissa Chang. I'm the Senior Business Development Manager for Allica Bank. I cover the Northwest region. I've been with the bank for roughly 2.5 years. So I work on the commercial lending side, supporting commercial owner-occupied and investment mortgages.
Chris?
Hi, my name's Chris Richards. So I'm Regional Manager for Newable Commercial Finance in the Northwest. Having only been in this role for months, I was previously a high street banker in the leisure and hospitality sector for about 10 years.
Thank you. Emma?
Hello, I'm Emma. I'm a Senior Associate at Sirius Property Finance. So I've joined their commercial team in March, and I help funding trading businesses where I specialise in healthcare and hospitality.
Thanks, Emma. Nick?
Yeah, hi, Nick Baker, Managing Director at Allica Bank. Work with Charissa and a team of 10 business development managers supporting our brokers across the UK.
Hi, I'm Paul Mak, MD at Pomegranate Commercial Finance. Business has been set up about 3.5 years, and before that, I was a high street banker for 20 years.
Hi, I'm Tom Clark from Napex Finance, Joint Managing Director. We've been set up for just over 3 years, or coming up 3 years, and prior to that, 20 years experience in banks.
Thank you very much. So we're going to head into the first part of our discussion, which is an overview of the market for these businesses. I think it might make sense to maybe start out with a definition of an owner-occupied trading business, and then look at the appetite for funding, which we've established is underserved, and then also what sort of trends there are from these borrowers and what they're looking for at the moment, just to set the scene a bit. Nick, may I come to you first for that?
That wasn't prepared. We didn't agree that. Yes. So for me, the definition is a simple one, which is it's all about the primary source of cash flow. Whether you're a broker or a lender and you're looking at owner-occupied mortgages, so it's not the widget maker that pays the rent to trade from the premises. It's all about the widget maker and their ability to continue to generate the cash flows that are required to support their business, service their debt, to thrive and grow. And the reality for me is many lenders lend to the property owner, the commercial investor. Very few have a distinct proposition. So some may do it, and some do it really, really well. A lot of our friends in the market supporting these types of borrowers, but few really have a dedicated proposition that supports the owner that operates from that premises. And you spoke, Caron, about COVID and market dislocation. Yeah, this was typically a market that was supported by the big four, but we know that appetite for a number of reasons has been disjointed for many years now. So pre-COVID, but COVID has exacerbated that. And the reality is a lot of those lenders, their focus has been on other areas, on fee bills, on bounce back, things that businesses really, really need. Brokers on this panel would have supported it. It would have given vital support to these businesses. But the reality is in a number of owner-occupied markets, lenders, and Chris, Paul, Tom would have dealt with this before in particular, will apply a traffic light to a trading business sector. This sector is now red, this sector is now amber, and it's a nonsense. It's an utter nonsense. There are good businesses in every single market, and for me, this owner-occupied commercial mortgage market is about supporting those businesses that will drive us forward and drive the economy forward. But again, primary source of cash flow is the absolute key. And I think that's where a number of lenders and sometimes a number of brokers can get tied up in knots if it's not their specialist field of competence.
Thank you, Nick. Charissa, would you like to add to that just general background that we're looking at? Oh, you're on mute.
Sorry about that. I knew that would happen. It had to be me first. Yeah, no, I mean, Nick's covered off a lot. A lot of the historic, a lot of customers, borrowers, they've all relied on those bigger banks, and obviously capacity, things, the different various factors have affected that, and they're looking for homes, and it is about finding a new home for that, where they can go. But these are the businesses that they're looking for, looking for their homes to go, new homes to go to, and they will bounce back. Sectors that have been hard hit, and we just need to look at how best we can sort of support them moving forward.
I think just to give an example to that, just to round up on Charissa's point, we've seen in the last probably 2 to 3 months some lenders that have previously been in the owner-occupied space actually looking to reduce their exposures at the time when the facility is coming up for renewal. So if you actually want a leading indicator of what's happening in that market, not only do we believe it's underserved, but actually that problem could become exacerbated in the next few months, especially if you overlay furlough coming to an end, bounce back, C bills going on to capital repayment over relatively short terms. We have seen a number of opportunities come across our desk from our broker partners where actually we're starting to see debt forgiveness. So at one end you've got a lack of new support for owner occupied, and at the other end you're going to have this squeeze, and that's £150 billion plus debt market. That's before overdrafts. So yeah, the brokers on the panel may have a different view, but for me, I don't see that situation necessarily improving anytime soon.
Well, I think
Tom?
from my perspective, I think we got during the lockdown, obviously we lost the high street banks, so the majority of all the high street banks stopped lending to new customers, which was then also kind of impacted as well by a lot of clients. You know, if they weren't trading with those banks, a lot of people don't trade with high street banks now for their main business banking. They use these smart new systems, so they didn't have access to these schemes because those lenders don't have access through all the products and the government incentives. So I think what we're starting to see now is we're seeing obviously the likes of Allica launching last year, which was incredibly useful to us and very supportive, which kind of combined at the same time with some of those lenders which were in that space pulling back in terms of appetite, or, you know, we would get that we're not lending in retail, we're not lending on pubs, we're not lending on cafes. It's like, you know, we're just lending on smart, you know, modern industrial at the moment, and not offices. So yeah, and we've also had that sentiment from the banks as well. So it is slowly coming back, but you know, from our perspective, you know, from a broker perspective, the market's dominated by the specialist lenders at this particular time, which again is also further compounded by the banks again sort of coming back, and we'll have good businesses which I would say 24 months ago would qualify for high street criteria, whereas now it's like, well, they took 2 bounce back loans which they can comfortably afford, but they're saying because they took 2 bounce back loans, actually you're saying you're in trouble during that period. It's like, well, the bounce back loans are the cheapest form of debt you're going to get. Why would you want to repay those loans if you can still comfortably afford to meet that debt, etc. So you know, that's kind of what we've seen through the period. But you know, businesses are still looking. You know, I mean, Nick, you've seen it on our side. You know, we've had businesses actually buying premises during this period. You know, and I know other businesses that are looking for premises. So we've had the losers, which have businesses which have struggled to trade, and then we've had the winners, which we've seen, you know, who have not struggled to trade and have actually gone out and bought premises. So it's been 2 very different sides to the story.
Thanks, Tom. Emma, is there anything that you would like to echo there sentiment-wise? Are you also seeing this traffic light approach to various opportunities in the commercial market by lenders?
Yeah, no, definitely. So especially in like hospitality and care homes, it's very difficult at the moment, especially if you're not someone that's such an experienced operator. So yeah, there's so many challenges, and in terms of obviously one of the things we've found is a lot of lenders are looking at accounts pre-COVID. So looking at pre-COVID, what happened during COVID, and how have they recovered? So we've found that is really helpful with with trying to achieve funding. But yeah, I agree with what everyone else has said.
Yeah, just like to add on that, Emma, that is one of the things that, you know, the common sense approach really that lenders need to be taking. You know, those businesses you mentioned in the sector, hospitality, retail, things like that, if they have, you know, can show that, demonstrate that performance pre-COVID, we can obviously see that blip that's happened sort of in the middle, and have an understanding of, and it is key, it's that commentary around how actually are they going to bounce back, and what are they doing, what steps are they taking, how can they demonstrate. You've got hospitality where there might be wedding venues, you know, they've got can demonstrate projections and future bookings, and it is looking at that whole picture, the story, the pre, you know, actually what happened.
Who they are as well, and like I said, they are an expert. If they've been running it for 20 years, they know what they're doing. So while high streets are against them, yeah.
And we can see from the little bit of movement we've had now with, you know, restrictions starting to lift, you know, people are eager to get back out there, and they are eager to go out and spend their money, and they are eager to go out and support, you know, businesses and have their weddings, have their events, and just general lunch in the pub. We can sort of see that actual happening. So it is, you know, that common sense approach of the whole story.
Paul, just coming to you, we're talking about the world reopening, but has that necessarily translated in the products that are available now? Are we seeing it sort of match with the rate of things reopening?
I think at the moment the high streets are very much still entrenched, dealing with their own clients only. I mean, we do quite a lot of owner-occupied lending, and if it wasn't for the likes of Allica Bank out there supporting, these business owners, I think it's going to be tough. Because I mean, I've got loads of examples where you've got clients from other banks who might want to go with another lender for cheaper rates or higher LTVs, who aren't just doing the business because I've had feedback from high street said, oh, it's not one of our customers, so to try their own bank and before they'll look to do it. So I think at the moment it's coming back. It's slow, and I think they're quite picky as well at the moment. So businesses, we know some businesses have been affected over the last 12 months, and they're not prepared to take a chance on it. And it's what Charissa said, it's that common sense approach, looking at previous history, looking at experience. They're very black and white, very much what I would call tick box. I'm also finding things like, for example, council grants in the leisure sector, which a lot of leisure businesses have received. They're stripping that out, so they're killing the deal from day one. Whereas, if you're looking at the last 3-4 years' performance and they've been at a certain turnover level, and it's been affected, so they're taking out the council grants, which makes it not affordable on paper. So it's that common sense approach that Charissa mentioned before.
And just to Paul's example there, to give you a real life example of a recent case we took into our credit committee. This was the sitting tenant of a very, very good country public house, and they'd actually been tenants for 25 years. So I think we can tick the box about their ability to run a business. In other words, they traded through the financial crisis, they'll trade through this. But the traffic lights hit, the high street traffic lights of red hit, so they could not get support to buy this business that they'd operated for 25 years. If you actually, and our broker did a terrific job on the case, and this is how we can work together with brokers to open these markets up. If you actually dug a little deeper, this business had benefited from business interruption insurance. Now, if you took that insurance and you took furlough and you took the fact that they'd cut certain other costs whilst they were shut, and you added in the fact that they did a takeaway service, this business had never had a more profitable year. Why would you not support that business?
Well, I think the argument I've seen before is, well, okay, this was a one-off experience. We don't know if this happened again, what the level of government support would be, etc. But I also put it down to not just the banks. I put it down to the bankers, if you want the truth. And I think there'll be certain bankers that will present a case, believe in something, and try to really support that client, rather than just applying okay, well, if we take that COVID year and we take the mean of the last 3 years' performance, oh, actually, it doesn't quite work. It's not a green tick in a box, it's an amber. It's about presenting that case and getting, a full understanding the wider picture, understanding the borrower, understanding their background, their track record, and thinking a little bit outside the box. The traffic light system, it's a really interesting one, because I understand that you may see traffic lights around sectors, especially that have proven to be impacted by COVID, so they're not shown as hardy as what manufacturing, engineering, food services, essential retail have been. But if that's the case, don't say we're not doing those. You temper your appetite. You want a bigger cash state, you want to be repaid quicker, you want a certain level of experience, you want a certain level of PG, for example. It's this sort of, we just don't do that at the moment, and then in 6 months we'll see and switch it back on again. That for me is the biggest problem.
Nick, just on that point, would you venture to say why it is that some providers pull back completely, as opposed to just bringing their criteria down to a level they can deal with?
Well, it's not a product-led market. So if you look at a lot of lenders across the commercial mortgage market, which is a broad church, bridging, development, commercial investment, owner-occupied, and we're involved in commercial investment as well, especially in semi-commercial, they tend to be product-led markets, i.e. you can have a product guide and lenders stick to that product guide, and then we get the tick box type mentality, which a product guide will drive, right? If you're doing bucketed loan to values, that's quite a binary market. So we might do that in commercial investment, in semi-commercial. In owner occupied, it's frankly impossible. So I think it's very, very difficult, because some specialist lenders that operate in the market have done that, and therefore you're setting up the boxes that you have to tick rather than taking a holistic approach and a case by case. I think a big part of this as well is underwriter experience and knowledge. There is a distinct shortage of underwriters, experienced underwriters in the market that have perhaps gone through a few cycles, who are SME focused, trading business focused. But then you've also got the dislocation that COVID's caused to lending businesses. So that might have impacted capability, i.e. the ability to actually get things done. But it's also really impacted capacity. And that capacity is the amount of transactions you can readily handle without your SLAs going to 500 days. But for a lot of specialist lenders that will continue to do really good work in this space, they've had their own funding impacted by COVID. So then you've got a bit of if they're wholesale funded rather than a regulated PRA, FCA bank deposit funded, they've got to get the money. So if you've got some question marks about where your money's coming from, you're looking in a market that perhaps you're in certain areas lacking on experience to understand, and then you're trying to tick all the boxes that Chris alluded to, you're not setting yourself up for success. It's going to become incredibly difficult to do the things you want to do. And that's why this market will continue to get impacted. And frankly, we're not big enough to solve the challenge. The broker market is big enough to help solve that challenge. We're actually really comforted that some new lenders are looking to come into this market, because it drives competition, it drives innovation. And ultimately, that's a good thing for the SME.
I think we needed that for a while, haven't we, Nick, as well, in terms of that lender spread, because it literally is high street specialist lenders and then adverse specialist lenders at the end, and there's not much in between those lenders. I mean, we found in the period that actually, like I said, we've seen both sides. We've seen businesses struggling, and Nick, you kind of know this with some of the deals we've done with you, but actually where I think a lot of the market might use bridging for a solution, we tend to be able to find that we don't have to do that. Like, if the business is solid enough, the income's there is almost enough width in the specialist lenders at the moment to support those companies. And yeah, I think the relationships come in as well, where we've seen that, on some of the trickier deals, that was still being supported on those trickier deals. So I think it's very much, I think it also comes back to, Nick, is how well it's presented. So it goes back to a lot of us are ex-bankers here, or been in the broker community for a long time. It's presentation to the underwriters of how that loan looks, and I guess where the banks differ to where you guys differ is, we go to the banks and we do all our ad backs, and we're like, well, you're not paying rent, they're not going to, this is going to come off, this is a depreciation that doesn't exist, So a lot of the actual non-physical costs, when we add back, the banks now aren't adding back those costs, and it's like they're taking quite a pure view. And a lot of businesses that are going out there if they're buying their first property or buying their trading premises, in most businesses that previous year, they're not going to just shed loads of profit in the business. So you kind of got to, whereas you guys, for example, Nick, will look at what's the actual client's, what's their cost of living, rather than how much did they take out of the business last year. So yeah, I think there's quite a lot of nuances in the space. And yeah, Nick, underwriter experience, you can just tell sometimes with the lender you're dealing with whether they've got any experience to kind of underwrite that.
I wonder, Thomas, sometimes these businesses just go in the too difficult bucket.
Yeah.
We'll probably do 250-300 million pounds worth of commercial investment offers this year, and that's absolutely fine. Valuable work. We're supporting investors, supporting our brokers, keeping the property market moving, along with other much bigger players in the market. But if you're an underwriter, you have a commercial investment case come on that's a dry rent and yield job, or you have a owner-occupied business with all that that means in terms of analysis, how often does it go into the too difficult bucket?
Yeah, it goes. I mean, depends on the lender. I mean, to be frank, you know, I'm pretty sure everyone else is the same here. As we'll maybe go to 1 or 2 lenders. We're going to go to where we think it fits day one, because there is no point putting the customer through, you know, okay, let's go to the high street for 6 weeks and slowly get a slow no, because, you know, especially where timing is of the essence on this deal. We had that last year actually on a purchase of really good business selling hand sanitizer pre-lockdown. Obviously, doing really well now. He was buying 3 industrial units. So he went to his existing bank, who threw us, and they said, yeah, we'll do it. And then we got down to it, and they stuck to some really, they wanted managed, they wanted the accounts which weren't due to be signed off, they wanted them into management form before they released the funds, which huge business. You know how long it takes to finalise accounts. It's just not going to happen. So that ended up going elsewhere. Yeah, and so I think those are the sorts of, you know, we're not seeing much flexibility from high street, whereas with the specialist lenders, we're seeing a huge amount of flexibility. I also think it comes down to how you talk to the underwriter as well. It's like you said, Nick, it's like, is it in the too difficult bucket? You know, back in my days as a lender, if someone's sent in 28 documents with no summary, I'm already kind of putting that bill to the back of my queue. So, because there's no summary in how, so that's key to me, really. I think you've got to do the work on those deals to get through it. Bizarrely, we find those deals more satisfying than the investment deals, because we know that actually, you know, it's supporting a hotel, it's supporting a restaurant, it's supporting a cafe. Actually, and also my side of it now, when you've got your own business, if you can avoid paying rent premises, and it's costing you less, plus you get to keep the asset at the end, that's really good for business. So I think that can't be lost these days as well. So I think naturally, once a business gets to a certain size, they're going to go and look to buy their own premises. We're hoping to see more opportunity in that market commercially, but actually, I'd say one of the challenges at the moment is a lack of stock around, bizarrely, in terms of what's coming to the market.
I just remind the panel, I'd like to continue on to the next week. If I can just remind the panel to pop themselves on mute when they're not talking. We just got a little bit of feedback coming through. Emma, if I can come over to you, just sticking on the theme of the underwriting of these loans, because it seems to be something that needs addressing. Expertise is clearly wanting, but just generally speaking, what are the quirks that are involved in underwriting these loans in a general market environment, and how have they changed as a result of the disruption last year and into this?
Oh, is that? Yeah, sorry, I was on mute. I find it really interesting. So obviously pre-COVID, things, like say, almost with a tick box, and it was a bit easier, and this is exactly what they wanted. And then now it's very much like negotiable on what exactly they want. So yeah, I think yes, really interesting at the moment.
Does Paul, does this sort of grey area make your job quite difficult as a broker?
I think for me, if you've got a lot of it in commercial owner-occupied lending, for me it's about storybook lending. So it's all the parts of who are they, background, experience, client base, succession planning, strategy. So I think as a broker, if you do a good enough job, or you do a good enough fact find, I think for the right client, you still get high street to fund it. It's for me at the moment, a lot of it is, a lot of high street are sector driven. So for example, you know, the leisure sector, for example, is the biggest one, where it's just a blanket no across the board. When I have got leisure clients, you know, for example, in the takeaway industry, they've made loads of money over the last 12 months because people aren't going to restaurants, so the takeaway industry has really flourished. People that want to buy the trading premises, or they're buying units that commercial units that aren't trading, which they've got proven track record of experience, but they might buy a shop that's closed down and hasn't been trading, but then the high street's saying, well, no, we can't do it because there's no financial support. But whereas pre-COVID, we could have said, right, here's their experience, this is what we're looking to do, similar site, similar geography, and we could get it. But now it's that side is tough, so you have to be more creative. So they're all chasing the the bigger clients with the where debt serviceability is easy to manage, whereas when we're proposing for a smaller end client, so smaller turnover, and a lot of it is lifestyle as well. So it's going back to Tom's comment about understanding what all their personal outgoings are. People, when I work with business owners, they do take everything out of the business because they can afford to do that. But when they've got debt, they will scale back and take less holidays, and it's just that common sense way of assessing a deal.
Yeah, so we found that in the care sector as well. So I had a client pre-COVID, so they had 2 existing care homes, wanted to buy a third. The third one was a requires improvement, and their existing were good with CQC. And at the time, the high streets would happily look at the story and obviously see that they've got a track record of turning homes around, so they'd have no problem with funding those. And then obviously now, pretty much all the high streets, it's a blanket no. It doesn't matter what the story is, it's just we can't look at it because they're buying a requires improvement. So that's quite challenging.
Charissa, dare I ask what happens if a business doesn't have the requisite trading history at all? So let's say they're set up just before COVID hit. How do you handle applications like that? Can you?
So at the moment there's a couple of things there. So new startup businesses where they've completely no experience, no trading history, they're not businesses obviously we can support because there's just nothing there, no support. But what we would look at is if you've got somebody who is sole trader or actually they've got sufficient experience. I have one recently that we supported somebody who was in hospitality, who was a chef for 20, 30 years, his own businesses, his lease businesses, and I have business abroad. And actually he's now, which pre-COVID, he worked for about 6 months actually in his own business, but then he had to sort of give up the premises. He was now looking to buy a premises, but saved money, he's got a deposit, looking to buy his own premises to trade from. Then that's, we've got sufficient experience in the background, we can look to sort of mitigate that lack of trading history. But he's got projections, and well, we don't work just on projection led, but the actual business he's going into was a business that was existing. So we look at those factors. So we're taking, Paul mentioned it, it's a storybook telling. Tell us about the experience, the borrower's background, what they've got, how they've operated, where sector they've operated, and the business that they're operating in, the trading in, and show us we've got some financials there. We'd expect to see some financials from that business, and look at ways in which we can sort of support it. There are challenges, obviously, with we see it all the time. You mentioned the complex cases. It's a lot of these are lifestyle businesses, so that's where we'd ask for more information. It is about where they're looking at low lending. It's we want to see more information than usual. Lease, tenant or borrower background. We want to see, there's a lot more analysis that goes on behind the scenes when looking at funding for an SME. And there's, you'll all find it on the panel. Nobody's, none of these cases are all the same. There's so many different. I don't think I've ever had 1, 2, 3 of the same. Might see the same case from different brokers, but not the actual same type of business, type of case, same background. They're all very much different. So it is. We would just have to look at the story, the background to it, and how we can support it in this new times at the moment that we're all experiencing.
Chris, I wanted to ask you how you're managing your clients' expectations in this part of the market right now. It's all very well, I think, for us to be talking about what should be happening, but how are they responding to this lack of appetite?
Struggling to understand it at times, shall we say, in terms of I'm highly experienced, I've got a good business. Not dealing well with declines, to be honest, from their existing bank, and just sort of, you know, looking for me, well, why would they decline me? What were they looking at? And sometimes it can be just, I mean, I had a case a few weeks ago where I was referred to someone from a bank manager who basically said, look, I'm not going to get you an answer for over 2 months. So if you need an answer quick, I'm sorry, I can't get, the only answer I'm giving you now is no. So obviously when they come to me, they've got an expectation in their head. They borrowed 2 years ago for a trading purchase at 2.5% over base over 15 years, etc. And it's setting those expectations in terms of, look, this is what you'd like and this is what you've achieved previously. This is the absolute ultimate backstop. This is what we know we can get you. So congratulations, you've got a deal. I know I'll get you that. This is where I think we're going to land with it. And then it's sort of setting expectations in terms of timescales and the type of funders as well. Because a lot of my clients have typically, they're high street banking. They've always had high street bankers. Something that they can look, touch, feel. They can walk down a high street previously and see a, you know, and walk into that bank and they understand what it is. So it is kind of going into the unknown as well. And they're saying, well, who are they? Who are they? And you're saying, well, all right, well, you know, we'll wait till we get the offers in and we'll present and go through them, etc. So yeah, there is a little bit of nervousness, but ultimately it's about delivering what they need, and most of them get on board with that.
Nick, just in response to that, and now I am going off script, do you find that there is this movement now in favour of specialist providers based on the fact that businesses are getting rejected and declined more often from their high street provider? Is this movement that we've hoped would happen accelerating somewhat?
There is, but it's all broker driven. Yeah, let's look back to the big four high street banks who own an enormous amount of the market, which is not going to change to any great degree anytime soon. It'll be a gradual change. But where it's broker driven for me is that SME business, if their primary, one of the big four didn't support them for whatever sector appetite reason, their accountant, their lawyer would refer them to one of the other big four. That's typically where professionals involved in this market outside of brokerage businesses, our broker partners, that's typically where those professionals would have gone. Now the broker is at the heart of that decision making. We've seen brokerages merge, we've seen them scale, we've seen them employ, we've seen them go into new markets. So for example, we launched into asset finance recently, and about 50 of our broker panel firms do both products, commercial mortgages and asset finance. That to me shows me that brokers are offering up a wider range of products and filling that advice gap. It's the brokers that will drive the take up in alternative lending. Yeah, we've not got funding circles, marketing budget, which is probably a good thing because we'd probably waste it. Yeah, we're not going to change that market on our own, and nor do we think we will. You know, as good as we're doing, and as well as the market supported us, that's, you know, the market's, yeah, like 150+ billion. That's without overdrafts, that's another 13 billion. So you're not going to scratch the surface. But if you've got the thick end of 2,500 brokers in this market that get to grips with this market, that refer transactions, as the panel have said, with the numbers as well as the words, so we can understand that, borrowers will become more used to dealing with the ones they can't, Chris, the ones they can't see, touch and feel. They'll become more used to that. And you know, us as a business, we're looking to build out our services into payment accounts and various other things to actually tackle some of those problems head on. And I think the lenders that have stood shoulder to shoulder with brokers at a really difficult time will come out of this well. But it's broker driven for me because they are the in-house FD and they're the ones that can access this market and get these deals done.
Tom, how does the weight of that accountability sit with you as a broker?
I think it's good. I mean, we find we deal with all sorts of trading businesses, whether from big through to very small. So I think what we're finding with, for example, on the bank side now, where our customers come to us to help us renegotiate their existing refinance with the bank, just because I think there's that thought in the back of their mind where they're going, am I actually getting a good deal? And is it just because I can't be bothered to move it, I'm staying here? You know, or what are the options outside of it? What else can be done for the business? Can we release capital? So I think it's really important now actually for business to have access to that. I think going back to one of Nick's comments, actually we get a lot of referrals from accountants this day. So, you know, the accountants will kind of approach us, and actually normally quite complex cases. But the same with the high street now. I mean, the high street, to defend the high street, actually one of the lenders has changed their process due to lockdown, and they have kind of gone, well, okay, well, what can we launch a service which is more appropriate towards the brokers. And also I think it comes into our play as well now, is lenders don't necessarily want to see clients anymore. You know, if they can do this and do a Teams meeting or Zoom call, you know, we're seeing, you know, we're not seeing that requirement now to go and touch the business, go and meet the business. So actually from our side of things, I'm having to say to customers like, you know, if we're presenting a pub in the middle of Yorkshire, you know, you actually get pictures in place where show them what it is actually physically lending on, because I think that helps a lot in terms of presenting the client and actually presenting their assets. Because if you say a location, sometimes people's mind is completely driven to the location, not looking at the asset, the performance of that asset. It's almost like a straight no. Whereas if you get your presentation right for the client, you know, and make sure you've done it properly, then you'll get the right answer in most cases. So yeah, I mean, it sits well with me. I feel comfortable, you know, talking to those customers about what can and can't be done. Actually, the commercial trading market is almost it's a hard sector to work in, because everyone here is actually, in terms of the analysis you have to do before you present that case, you've got to do a lot of work around that. But at the same time, actually, the fact there's not a huge width of vendors in the space at the moment is kind of makes our job a little more simpler. At the same time, there's obviously a lot of restrictions to that, and you know, I don't know how the rest of the panel feel here. I mean, I always tend to try and avoid bridge commercially, just because professionally, you know, if we're putting them into it, we've got to get them out of it. So, like, you know, are we confident we can get the clients in and out of that product, and are they going to perform? You know, have we? You know, how do we understand? You know, and actually, coming back to what we've done with some of the deals with Allica, we've been able to kind of not use bridging in those cases. And so, like, the product set across the market for our clients now is you've got your commercial mortgages, you've got your corporate facilities, you've got your bridging ranges, which are useful depending on the case. But I think, you know, 9 times out of 10 clients want long-term funding day one, and it sometimes doesn't matter whether that costs 2.5%, whether that costs 7%. You know, they want that commitment that they're not going to be having to look over their shoulder, you know, every 24 months and renew their facilities. We also see with the banks now as well, where they normally do like a 5-year review, and now coming back and say, we're going to do 1 in 2. So it's like, you know, that can involve a full valuation, new fees. So yeah, I think it's becoming quite tough for the businesses now to be constantly overviewing what the banks are looking to do. And even if they've got their own in-house finance director, we're still speaking and working with the FDs, because they're not dealing with the market every day. You know, for them, they've still got to go and trawl the market and find out what's available out there.
Yeah, I think especially over this period as well, it's changing daily what lenders are doing and what they're not. So yeah.
To Tom's point there, I mean, the title of this session is it an underserved market, or why is it so underserved? And it doesn't really matter. If you've got lenders offering loans to trading businesses, very often family owned, and they're doing 2, 3, 4, 5-year commitment periods, that's outrageous. You wouldn't accept that in your personal life. You know, why would these businesses accept that? And, you know, to the underwriting point that we made earlier around experience, and to the broker's experience and the numbers and the words and packaging it up and doing your cash flows, if you are lending to that business, with a view that you need to take a really hard review of that business in 2 years, you've lent to the wrong business.
It's quite an interesting point, Nick, actually. And I had a deal going back a few months ago, actually, when I first started here. You guys put terms out on it, and so did 2 high streets. And the rate on the high streets were more competitive, but the fact that they wanted, this client said, you know, I'm in it for the long haul. I'm probably going to have this mortgage for 20 years, 25 years. So when you actually work in the fact that at every 5 years, these guys are going to have to pay 1%, 1.5% as the debt amortizes down. I ran those numbers for the client, and Allica's offer was much stronger. So when you pull away from the headline rates and actually get underneath what's the client's view, rather than just sort of, you know, race to the bottom on rate day one, it was the right product for them. And the fact of the matter is they didn't want to have to go into negotiation. They were a very non-sophisticated business. They do not want to have to go into negotiations after 60 months or really after 48 by the time they start then having to go back out to market again. Do they want to do that job themselves? Do they want to engage me again at that point? So, you know, Nick makes a really, really strong point there that I worked for NatWest RBS during the financial crisis, and this whole 5-year commitment thing came about due to term liquidity premiums, cost of funding. It was effectively so they could say, well, if we haven't got to look that far into the future on our rates, we'll give you a 5-year commitment rather than 15, 20, 25, and we can offer you a more competitive margin. We can offer you the margins we were offering you pre-financial crisis. And that was it. And customers have just sort of got sucked up in it, and now it's the norm. So you're going and putting 5-year commitments on 350 grand deals, whereas before those were always reserved for £1 million plus, you know, deals for more sophisticated businesses, and typically not always owner-managed businesses as well.
Yeah, and we see this quite a lot, Chris. We'll get inquiries and applications where the borrower's got obviously existing facility, thinking they're in it for, you know, a little bit longer, and then, you know, they might go back for, you know, they want to do some growth or some reinvestment into the business, you know, get some cash for that, and they, you know, the terms change. The banks, they use it as an opportunity to change, you know, to change the facility, you know, withdraw the facility even. We've seen that, you know, a number of times as well. And the key is obviously understanding the actual business we're lending to and looking at, you know, the plan and having that commitment to them.
Absolutely.
I'd like to just come over, Paul. We've got a question from the audience here about what the loans are being used for in the main for those who are able to obviously cross the threshold and get them advanced. Tom mentioned earlier that he was seeing a lot of property acquisitions, but obviously you could use it for growth or reinvestment. What are you seeing?
I get a mixed bag. Every client is different. So, you know, I just want to go back to comments. You know, we're saying banks haven't got appetite, but I think brokers are key. Experience of brokers, background, because I think Tom mentioned brokers that are bridging owner-occupied premises. I'm not a big fan of that. For me, because, you know, I'm coming from the high street world. If we're going to deal with owner-occupiers and SMEs, then we should be doing our best to get term debt for clients and not quick wins. So I think, you know, if you're going out and using brokers, research your brokers. You know, what have they done before? What type of products do they deal with? I think that's really key. I think that's where it starts with as well. If you're coming out using brokers, every scenario is different. So, you know, if you've got a existing property already, and you're using that to refi for growth, yeah, we see that. Or a good example is I was with a transport business a couple of weeks ago, and he'd been renting for the last 10 years, and, you know, made a flippant comment about it being on a residential estate, and the neighbours must love him. And he said, oh, well, you know, we're actually moving to a new site on a lease, and I made, you know, I worked out there for him for the same, to get a commercial mortgage. We were saving him about £6,000 a year versus renting. So again, he would never think to buy until, you know, you know, I'd sat there and worked the figures out for him. So yeah, you know, people getting mortgages, they can use it for any reason, as long as, you know, with lenders that they prefer to use it for business use, so not for personal use or to repay a director's loan into the business. And does it make sense?
Thanks very much, Paul. I just want to come on to just our final point here, just to round things off. We've got a few minutes left. Nick, what would you say the wider, if lenders, brokers, and everyone else involved doesn't get it together to support these businesses, what's the wider economic impact of this?
The biggest impact is we'll never all meet in a pub again, because they'll all be shut. Then we won't be going. Well, there's a very simple way of looking at it, and then there's I think a slightly more nuanced way. The simple way is there's 2.7 million businesses in the UK that are registered for VAT or PAYE. Those 2.7 million businesses, 99% are SMEs, so the market we're talking about here. All the trends show that either product or lending innovation has been focused on either the bigger corporates, or, to Tom's point earlier, out where people are banking, the micro SMEs, you know, some of the fintech players that service that freelancer community or micro SME businesses. The implied SME lending appetite is demonstrated in the fact we're going to put out £500 million worth of offers this year, and actually probably trend slightly ahead of that. And we are growing, but we're still a small part of that puzzle. So actually this impact is, let's just think for a moment of how many people are supported by those 2.7 million businesses that are in that SME brackets. Yeah, they're the people that will give our sons and daughters their first jobs. They're the businesses that are run by your next door neighbour. You know, they're the side businesses that are run by your child's teachers. The permutations are almost endless, but yeah, that is what drives us out from an employment perspective, from a staycation perspective. You have to, if you want a staycation, you need to support hotels. Yeah, it touches absolutely every part of our life. The employment numbers for those 2.7 million businesses are staggering. And there is a direct link here to supporting these businesses versus the wider economy versus employment. Yeah, there simply has to be. But also, you know, to the trends point, we're really, really pleased by how many opportunities we're seeing that are about growth. Yeah, it's not about recovery, it's about growth. The businesses that have traded well are looking to go again. Some investors that perhaps came out of the market recently, seen perhaps some headline values and yield change that are attracting them back in. They did the same after the GFC, so they've seen their returns, they've sold, they're coming back in again. So I think there's a real growth story here. The challenge is not talking ourselves out of transactions that, to Paul's point, make sense, that have such a wide knock-on impact across the economy.
Thanks very much, Nick, for that. I think that rounds us off quite nicely, but I'd like to, the conversation was very interesting, and thank you to the panel. I just would like to come to each of you very quickly for any final thoughts on the topic, or anything you'd like to leave the audience with. Charissa, I'll start with you.
No, I think most of the points have been covered here. It's you know, brokers, you guys are, you know, pivotal. It's really play that important role in getting these borrowers, you know, the funding and lending requirements they need to get the growth plans going, to kickstart the businesses again, so we can all sort of get the economy moving. And it's just, yeah, that's what we need to do.
Thank you. Emma?
Yeah, no, I just, like what Charissa said, I think brokers are really important at the moment, and obviously I can say that because I am one, but yeah, and just in terms of with the market changing so much, it's more important than ever for us to keep up with all these different banks. And obviously there's a few new banks that are going to be similar to Allica that are coming about over the next couple of months. So yeah.
Thank you very much. Tom?
Yeah, I think it's going to be a really exciting period, actually, over the next 6 months of opportunities for brokers, in particular in this space. So, like I said, it's like one we probably get the most enjoyment out of. because you're directly supporting trading businesses. You can actually see the impact that has. So yeah, no, we're excited about what this market's going to do, but also like you've all said, we're also excited to see some new lenders coming into the space, which I think is really good. So and I think the bank's got a huge market share, but like in other sectors, that with more lenders coming in, that will drive down their market share and it will make the market more competitive. So I look forward to seeing that.
Thank you very much, Chris.
Yeah, I think our role's only going to get more important. I mean, I badge myself as an independent bank manager. I've just got 15, 16 credit forums rather than having one now. The banking market since the financial crisis has become massively fragmented. We know that banks are becoming more and more faceless. I think our role will become more important. High street banks, in my opinion, I know for a fact, having spoke to people and know people quite senior in a few of them, their financial plan, they're actually ahead of 2023 financial plan in terms of where they thought they were going to be lending wise, let alone all the CBILS, bounce back fraud and all the other sort of issues that's going to cause and the mopping up of that. So I think guys like Allica have got a massive part to play alongside us here, because I think we really need to assist getting liquidity to what is an underserved market.
Thank you, Chris. Paul, final thoughts?
I think Chris stole my thunder there, because I do class myself as an independent bank manager, but I call it that whole of market. I think with some of the new banks that are coming, like Allica, who've been in the market a couple of years now, and then some of the new ones that are coming in and understanding their policies and criteria, I think they're going to give the high streets their money on appetite and supporting SMEs. So for me, I'm excited about the next sort of 6-12 months of what's coming in the market.
Thanks, Paul. And finally, Nick, what would you like to conclude with?
Just a simple one from me. Don't get too excited about these other people, okay? You don't want to get too excited about those. No, just thank you to Bridging and Commercial. Thanks, Caron, for hosting us today. I've always thought it's a market that isn't spoken about enough given its impact. But hopefully this will help show some of the opportunities available in the market, some of the directions of travel, and hopefully it can become a bigger part of the industry's conversation. But really enjoyed it, so thank you for hosting.
Thank you very much for supporting it. I think I've learned quite a bit, and we'll also do our part as a publication to make sure that the flag is being flown for this part of the sector. So thank you very much to Chris, Paul, Tom and Emma for joining us, and then again to Charissa, Nick and Allica for supporting us. We're going to wrap this up now. Thank you very much to everyone for tuning in. The video will be available to watch in full next week, early next week, along with a short article on the highlights. So if you feel that anyone could benefit from watching it or sharing it, then please do so. They will be available on Bridging and Commercial online. But that just leaves me to wish everyone a fantastic rest of your day and week. And yes, we'll see you next time.